Cash flow statement. Every business organization is interested to know how various organizational activities lead to cash inflows and outflows in order to optimize the financial flow. This is done through preparation of cash flow statement. Let us discuss. Cash flow statement. Preparation of cash flow statement. Calculation of net profit before tax. Cash flow from operating activities. Cash flow from investing activities. Cash flow from financing activities. Meaning of cash flow statement. It shows flows of cash and cash equivalents during a particular period. Prepared when there is any change in cash and cash equivalents due to any transaction. For example, payment of rupees 10,000 to a creditor leads to decrease in cash. There are two types of cash flows: cash inflows and cash outflows. Transactions which increase cash, including cash equivalents, are inflows of cash. Transactions which decrease cash are outflows of cash.
Objectives of cash flow statement. These include assessing sources and uses of cash, assessing trend of cash flows, helpful in preparing cash budget, exercising control and better utilization of cash. Limitations of cash flow statement. Lack of accurate assessment of liquidity. Ignoring non-cash transactions. Ignoring accurate concept of accounting. And historical in nature. Preparation of cash flow statement. In India, cash flow statement is prepared as per AS3. Cash flow statement may be prepared either by direct method or indirect method. Here we will study only indirect method of preparation of cash flow statement. Cash flow is calculated from three types of activities. These are operating activities, investing activities, and financing activities. Operating activities are those activities which are directly concerned with operation of a firm and are major sources of generating revenues and use cash. Cash inflow from operating activities and cash outflow in performing operating activities constitute cash flow from operating activities. For example, cash sales, cash purchases, etc. Investing activities are those activities which involve purchase or sale of non-current assets and earning revenue from use of these assets in non-operating activities. For example, purchase of a machine, sale of an old machine, purchase of patents, rent received, etc. Financing activities are those activities which are related to raising funds and repayment of those funds, like issue share capital, issue of debentures, taking long-term loans, redemption of debentures, repayment of loans, payment of interest on long-term borrowings, payment of dividend on share capital, etc. Format of cash flow statement. Format of cash flow statement is given below.
Guidelines for preparation of cash flow statement. Accounting standards provide certain guidelines for the preparation of cash flow statement. These are: make adjustments for non-cash and non-operating activities in the net profit before tax. Net balance will be operating profit before adjustment of working capital. Calculate net adjustment of working capital. Deduct tax paid. The net balance will be cash flow from operating activities. Calculate cash flow from investing activities. Net balance will be cash flow from investing activities. Calculate cash flow from financing activities. Net balance will be cash flow from financing activities. Calculate total cash flow by adding cash flow from all the activities.
Calculation of net profit before tax. To do this, we need to add tax and other extraordinary items at the end of the financial year. This means in the net profit of the current year, proposed dividend and provision for tax is added. Cash flow from operating activities. For this, we need to add loss on sale of computers and patents written off and deduct profit on sale of investments from the net profit before tax to get operating profit. To get operating profit, we need to add decrease in current assets and increase in current liabilities and deduct increase in current assets and decrease in current liabilities to get cash generated from operating activities. From that, we need to deduct tax paid to get net cash flow from operating activities. Cash flow from investment activities. To calculate this, we need to add purchase of land and building, purchase of plant and machinery, rent received, dividend received on current investment, and interest received on 10% non-current investments. Cash flow from financing activities. To calculate this, we need to add proceeds from issue of 10% debentures, repayment of long-term loans, payment of interim dividend, and payment of final dividend.